This is the Lex Beyond podcast by Lexicon Labs. I'm Lex.
And I'm Bianca.
So if you point at a car on a dealership lot and tell me, that car goes 200 miles an hour, that is a completely testable, literal truth.
Right, you can literally take it to a track and prove it.
Exactly. I can push the pedal down and see. But if the salesman looks at you and says, hey, this is a safe family vehicle, you have just crossed into some really dangerous territory. It depends entirely on how we choose to define the word safe. Like, if your definition is just, it has seat belts, then sure, it's true. But if your definition is, it won't encourage my teenager to go drag racing, then it's totally false.
I love that analogy because that distinction between a literal truth and a financial truth is the invisible engine driving basically every major conflict in our markets today.
Which brings us to the mission for today's deep dive. We are looking at some fascinating sources ranging from 1930s legislative history to modern financial valuation to decode one incredibly weighty word in finance. True.
Right. And I was actually watching a Fox Business segment recently where they introduced SEC Chairman Paul Atkins as a truth-telling chairman.
Which, you nod along to that. Every SEC chairman should aspire to tell the truth.
Of course. But the real question is, what does truth actually mean in financial markets? Because it's rarely just a binary fact.
Right. Like if I say, Bitcoin went up in price yesterday, that's a literal truth. The data proves it. But when someone gets on TV and says, crypto is a good investment, we are right back on that car lot.
Exactly. It hinges completely on how we define investment, and that is the central problem.
Because right now, there is no accepted legal definition of investing, is there?
No, there isn't. And as a result, the definition just gradually becomes whatever the financial industry wants it to become.
Right, they just warp it to fit whatever product they're pushing.
Exactly. Once that happens, literally anything can be sold to you as an investment. Digital tokens, rare sneakers, virtual land. So we have to establish a functional definition before we can even look at the current market.
So let's do that. What's the definition?
Investing is purchasing the right asset at the right price.
Purchasing the right asset at the right price. It sounds simple, but I have a feeling the word right is doing a massive amount of heavy lifting there.
Oh, it's doing all the heavy lifting. Let's break it down, starting with the right asset. In finance, the right asset means it produces cash flows for its owner.
Okay, so like a business.
Right. When you buy a stock, you're buying fractional ownership of a business, which gives you a claim on future cash flows. When you buy a bond, it generates contractual interest. Rental real estate produces rental income.
So to use a really folksy analogy for everyone listening, when you invest, you are basically buying a milk-producing cow.
I like that, yes.
You can measure the milk, you can sell the milk, but when you speculate, you're just buying like a rare baseball card. The card doesn't do anything. It just sits in a plastic case.
Exactly. You're just hoping the next guy wants the card more than you do and is willing to pay a higher price. But assets that produce cash flows, your cows, they can be valued because they generate actual economic activity.
Okay, so that's the right asset. What about the second half? The right price. I know Wall Street loves to use jargon like discounted cash flow, but can you unpack that without the buzzwords?
Yeah, let's keep it simple. Think of discounting like inflation in reverse. If I promise to hand you one real-world dollar 10 years from today, that promise is not worth $1 to you right now.
Right, because a lot can happen in 10 years.
Exactly. First, I might go broke and never pay you. Second, there's an opportunity cost. If I gave you that dollar today, you could put it in the bank and earn interest on it for a decade.
So to figure out what your future dollar is worth today, I have to penalize it, I have to discount it.
Spot on. You estimate all the future cash flows, all the future milk, and discount them to the present. You add all those up, and that gives you the intrinsic value.
Got it. But the future is totally unpredictable.
Right, and that is why investors require a margin of safety. The future is unknowable. We can't predict pandemics or supply chain crashes.
Break that down for me.
Sure. Let's say you do your reverse inflation math, and you estimate the intrinsic value of the asset is exactly 100. If you buy it below 70, meaning you have a 30% margin of safety, that is investing.
Okay, what if I buy it at 85?
Buying between 70 and 100 is speculative investing. You might be right, but your safety net is shrinking.
And what if I pay 110 for it?
Paying over 100 is pure speculation. You are relying entirely on the hope that someone else will pay 120 tomorrow.
This sounds exactly like Benjamin Graham.
It is entirely based on Graham. He laid out this framework almost a century ago. He said an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return.
Right, and anything else is speculative. So there are three non-negotiable elements there. Thorough analysis, meaning you understand the cash flows.
Yes, and safety of principal, which is your margin of safety.
And an adequate return, meaning you get compensated for the risk. But, I mean, this doesn't guarantee you'll get rich, right?
Not at all. It just improves your long-term decision-making. It grounds you in reality.
But wait, Graham's whole thorough analysis thing is completely impossible if companies are lying.
Right.
Like if the guy's selling me the cow says it produces 10 gallons a day, but it actually produces 0, my math is going to lead me right off a cliff.
And that realization is exactly why the SEC was created in the first place. To understand this, we have to look at the ghost of the 1930s.
The Great Depression.
Yeah. After World War I, during the Roaring '20s, there was this massive explosion of wealth. $50 billion in new securities were floated to the public.
50 billion. That's a lot for the 1920s.
It is. And when the crash happened, congressional reports showed that half of those securities were completely worthless.
Wait, I remember this from the source material. If you adjust that 50 billion for inflation, it's about $1.1 trillion today. And just for context for you listening, today's crypto market is hovering around 2.1 trillion. So the speculative appetite of the public hasn't changed at all in a century.
Human psychology is permanent. The numbers just get bigger. And wherever there's that kind of irrational appetite, you'll find people ready to feed it.
Enter the Jackal of Wall Street.
Yep.
I absolutely loved this character in our deep dive, George Graham Rice.
Right, also known as Jacob Simon Hersig.
A convicted forger. He wrote a book from prison where he basically laid out his entire con. He noted that Americans have an insatiable desire to speculate, but they want to feel responsible.
They want the thrill of the casino, but they like to delude themselves into thinking they are investing.
And so Rice just catered to that delusion. He disguised speculation as investment. But, I mean, game recognizes game. But how on earth do you regulate an entire market full of jackals who are weaponizing human nature?
It was a massive philosophical dilemma for Congress and FDR. The temptation was to create a nanny state, to have the government tell people what they could and couldn't buy.
But they didn't do that.
No. FDR's solution was what we call the 1933 and 1934 bargain. He added, "Let the seller beware," to the old rule of "let the buyer beware."
So total neutrality. The government wouldn't guarantee value or tell Americans what to buy.
Exactly. If you wanted to buy a terrible business, you could. But the government forced promoters to provide full, fair, and truthful disclosures.
Using sunlight as a disinfectant.
Yes. They closed the information gap. Once the ledgers were open, citizens could do the math and make their own choices.
Okay, so the 1930s laws beautifully solved the disclosure problem, at least for assets that actually generate cash flows, right? But if we look at today, the problem isn't just disclosure anymore.
No, it's fundamentally a problem of definition.
And this brings us right to the crypto conundrum. Because, look, people speculate on stocks all the time. People overpay for great companies every single day.
They do, and the government shouldn't prevent that because the investors have the information needed to value those businesses. They're just choosing to ignore the math.
Right, but crypto is a completely different animal.
Entirely different. Because, going back to our framework, crypto does not generate business or contractual cash flows.
The cow produces no milk.
Zero milk. So it cannot be valued through traditional cash flow analysis. Its intrinsic value, according to financial heavyweights in our sources, like Aswath Damodaran, Warren Buffett, Jamie Dimon.
It's literally zero.
It is zero. Its price depends 100% on what someone else will pay for it tomorrow.
Now, hang on. I want to jump in here and do a quick impartiality check. We aren't taking a side here. People have made absolute fortunes on Bitcoin, and it could go to $1 million a coin tomorrow. We aren't saying crypto is evil, right?
Absolutely not. Trading crypto is neither illegal nor immoral. People should remain entirely free to speculate.
Right, but if you want to roll the dice, roll the dice.
Exactly. The issue is purely definitional. Both Chairman Atkins and former Chairman Gensler, who have very different regulatory approaches, they both accepted the premise that one can invest in crypto.
They blur that vital line between investing and speculation.
Yes. They allow the word investing to be applied to an asset with zero intrinsic value.
Which takes us right back to the Jackal of Wall Street. It gives the public a false sense of security. So if the government's job is neutrality, if we shouldn't ban crypto, How do we protect you, the listener, from the modern-day jackals?
Well, truthful disclosure has to evolve to reflect this distinction. And the solution proposed in our sources is brilliantly simple.
The warning label.
Yes. Imagine if every single crypto purchase simply included one prominent disclosure. This is a speculative asset.
Oh man, just think about that. The government wouldn't be telling you what to buy. It would simply be telling you what you were buying.
Exactly. Not illegal, not immoral, simply speculative.
If you want to go to the casino, go. Just know that you were at the casino, not the bank.
Right. And if we look at the big picture here, once we understand that investing is purchasing the right asset at the right price, the whole crypto debate shifts.
It shifts from politics to finance.
Completely. It is not a partisan issue. It is a definitional issue.
You know, it took the absolute devastation of the Great Depression to produce a revolution in truthful disclosures.
Let's really hope we won't need another massive financial crisis to realize that truthful disclosures have to be accompanied by truthful definitions.
Seriously. And that leads to a final thought I want to leave you with to mull over. Our sources told us that the speculative appetite of the public is an insatiable, permanent part of human nature.
It never goes away.
Never. So if regulation is always reacting to the last crisis, and promoters are always finding new ways to disguise speculation as investing, what is the next crypto going to look like? And more importantly, will you be able to spot it before the government finally forces them to slap a warning label on it?